U.S. Tax System for Accountants, Section 2 of 7, the 7 types of U.S. taxes. Welcome back to The Explainer. In our last session, we laid out the overarching 3-level tax architecture. Today, we're taking that broad blueprint and bridging the gap to the practical reality of what you're actually going to see in the field. Because look, before you even start analyzing a client-specific situation, you have to establish exactly which rulebooks apply. As we'll see, the federal government, the states, and the various localities, well, they each administer completely different types of taxes. And if you misidentify which game you're playing, that can be absolutely disastrous for your client. Here's our agenda for today. We'll start with the tax type landscape, dive into income and payroll taxes, explore sales and property taxes, cover estate, excise, and customs, and then finally wrap things up with our core takeaways.
All right, let's jump right into Section 1, the tax type landscape, mapping the 7 domains.
So here is a comprehensive map of the 7 categories of U.S. taxes. As an accountant, this right here, this is your universe. It stretches from everyday income and payroll taxes administered at the top by the IRS, down to property taxes handled by your local county assessor, and literally all the way over to customs duties managed by U.S. Customs and Border Protection. We're talking different taxes, different payers, vastly different rates, and completely different enforcing authorities. It's kind of like a giant puzzle you need to piece together for every single client. Moving on to Section 2, income and payroll taxes, the heavy hitters. Okay, so income tax, it's the massive revenue engine for the government, but there's a really stark contrast between how the federal and state levels handle it. Federally, we've got these reliable, progressive brackets for individuals ranging from 10 to 37% and a straightforward flat 21% rate for C corporations. But at the state level, that's where we see dramatic variability. Rates can go from 0 all the way up to 13.3%. In fact, there are 9 states that impose absolutely no personal income tax at all. So practically speaking, your client's geographic footprint fundamentally changes their income tax burden. That brings us to our second heavy hitter, payroll taxes. These are what fund Social Security, Medicare, and unemployment. Now, employers and employees each pay a 7.65% FICA tax, making it a combined 15.3% on wages. So imagine a client comes to you and thinks they found a clever little loophole. To avoid that hefty 15.3% burden, they intentionally misclassify their workforce as independent contractors instead of employees. Ask yourself, what actually happens when they get caught? Well, the consequence for that misstep is totally devastating. It's called the trust fund recovery penalty. If a client willfully fails to collect or remit those payroll taxes, the IRS doesn't just slap a fine on the business. No, they completely bypass the corporate shield. That means the responsible officers of the company are held personally liable for 100% of the unpaid trust fund taxes. Their personal bank accounts, their homes, the whole shebang. It's all on the line. It is an absolutely severe consequence of messing up this specific tax classification. Let's transition to Section 3, sales and property taxes, state and local domination. Now, this surprises a lot of international clients, but the U.S. actually has 0 federal sales tax. Federal involvement here drops to absolute 0. It is entirely a state and local game, and rates vary wildly. You've got states like Oregon, Montana, Delaware, and New Hampshire sitting at exactly 0%, while other regions can soar to over 10% when you combine the state rate with specific local city or county additions. This actually builds into a really common compliance trap, the difference between sales tax and use tax. Sales tax is pretty straightforward, right? It's collected by the seller right at the point of purchase within that specific state. But what if your client gets smart, drives over to one of those 0% states like Delaware, buys a bunch of expensive office equipment, and brings it back to their highly taxed home state? Well, that is exactly where the use tax catches them. It applies when goods are purchased without sales tax and then brought into a taxing state for use. Honestly, failing to accrue and pay use tax is one of the most common audit adjustments accountants have to fix for their clients. Rounding out the local level, we've got property taxes. These are paid by owners of real and personal property, and they're administered entirely by county or city assessors. The big takeaway here is that this is a reoccurring annual cost, typically ranging from 0.5% to 2.5% of the property's assessed value. And because it varies entirely by specific locality, your client could literally move their warehouse just one county over and completely change their property tax burden. Crazy, right? All right, on to Section 4, estate, excise, and customs, wealth and specialized taxes. Take a look at this number, $13,610,000. This is the 2024 lifetime exemption for the unified estate and gift tax. Basically, if your client wants to transfer wealth to their heirs, either during their life or after death, any amount over this lifetime exemption gets hit with a massive 40% federal rate, administered by the IRS. But there's a looming cliff for high net worth clients that you need to be aware of. Back in 2017, the Tax Cuts and Jobs Act significantly increased this lifetime exemption. So right now, in 2024, it sits comfortably at that 13.61 million mark. But look at 2025. There's a scheduled sunset of many of those TCJA provisions right at the end of the year. So unless Congress actively intervenes, in 2026, that generous exemption will be slashed by roughly half. This right here is why tax planning isn't just about the present. It's about anticipating these legislative time bombs for your clients.
Finally, we have our highly specialized taxes, excise and customs. Now, while these are definitely less common in everyday advisory work, if your client is in manufacturing, distribution, or import/export, they are absolutely critical. Excise taxes are per-unit taxes on specific goods. Think fuel, alcohol, tobacco, and firearms. Depending on the product, you're dealing with the IRS or the Alcohol and Tobacco Tax and Trade Bureau. On the flip side, customs duties hit importers. Rates can range from 0 to over 25%, depending entirely on the country of origin and the harmonized system classification of the goods. And that's all administered by U.S. Customs and Border Protection. Miss this, and your client's profit margins on imported goods will literally vanish overnight.
Which brings us to Section 5, Core Takeaways. Let's summarize the landscape.
Let's recap what we've accomplished today. You're now fully equipped with the mental filing cabinet you need. You can identify the 7 major tax types, who pays them, and exactly which authority governs them, from the IRS all the way to the CBP. You understand the absolutely devastating personal liability hiding behind the trust fund recovery penalty for payroll taxes. You recognize that state and local taxes, like sales and property taxes, vary wildly based on simple geography. And you're prepared to anticipate that massive 2025 sunset for estate tax exemptions for your wealthy clients. So you know the landscape, you know the 7 tax types, but as you prepare for our next explainer, I want to leave you with a provocative question. Now that you know what these taxes are, do you know exactly how the IRS structures its authority to actually enforce them against your clients? Because in our next lesson, we're going to decode the 7-level hierarchy of the IRS, starting from the supreme law of the U.S. Constitution all the way down to everyday IRS publications. Get ready, because understanding that hierarchy, that is exactly how you win an argument with an auditor. I'll see you in the next explainer.